Ever get that feeling, when you're reading financial news that it's like reading a foreign language?
Yes, sometimes.
Well, you're not alone.
Right.
So today, we're going to be breaking down some articles that you sent in about the U.S. dollar and some of the latest economic data.
Yeah.
Think of us as like your financial translators.
Absolutely.
We're here to help you make sense of all of this.
Yeah, and believe me, there is a lot to unpack.
I bet.
The U.S. dollar index,
Mm-hmm.
the DXY we always hear about,
Right.
that took a bit of a tumble recently.
It did.
And this happened right after the Personal Consumption Expenditures report came out.
Okay.
PCE.
The PCE.
Yeah.
That rings a bell. But remind me, why should we care about that?
Well, it's one of the Federal Reserve's favorite ways to measure inflation.
Okay.
You see, the Fed is always trying to keep inflation
Yeah.
from getting too high or too low.
Right. They want that sweet spot.
Exactly.
Yeah.
That Goldilocks.
Yeah, the Goldilocks scenario.
Perfect scenario.
Right. So they've been raising interest rates all year to try to keep things in check.
Right.
So what did this PCE report tell us? Did things actually get cheaper?
Well, the report came in a bit softer than expected. Monthly inflation was just 0.1%, and the annual rate landed at 2.4%.
Okay.
Analysts were predicting it to hit 2.5%.
Gotcha.
So it seems like inflation might be easing up a bit,
Yeah.
but it's not quite as simple as saying things are just getting cheaper across the board.
Okay. I see where this is going. Softer inflation sounds good, but it probably complicates things for the Fed, right?
Absolutely.
Yeah.
The Fed has been taking a pretty hawkish stance lately.
Right.
They're really determined to fight inflation, even if it means slowing down the economy a bit.
Mm-hmm.
In fact, they just signaled that they might cut interest rates less than initially planned in 2025.
Which would help support the dollar because higher interest rates tend to attract more investors.
Exactly.
Okay.
But now this softer PCE data is
Right.
throwing a bit of a wrench in things. Will the Fed stick with their hawkish plan, or will they ease up a bit? The markets are definitely on edge trying to figure out what's next.
It's like watching a high wire act, isn't it? Too much inflation is bad, but raising rates too aggressively could also backfire?
Yeah, it's a constant balancing act for sure.
Yeah.
And to make things even more interesting,
Okay.
we've got some other economic indicators that are painting a slightly different picture.
Okay.
For example, Q3 U.S. GDP growth came in strong, 3.1%.
Wow.
And consumer spending remains pretty solid.
Really?
Yeah, so this suggests that the U.S. economy is actually pretty resilient.
So it sounds like we've got a mixed bag of signals here.
Yeah.
On one hand, the economy seems to be chugging along, but inflation might be cooling down.
Right.
What does this mean for the average person who's just trying to understand all of this?
Well, first and foremost, it creates a lot of uncertainty.
Yeah.
No one knows for sure what the Fed is going to do next.
Right.
And that could make investors a bit nervous. And we've seen how that uncertainty can impact the value of the U.S. dollar.
And a fluctuating dollar affects everybody.
Absolutely.
Yeah. It changes, the cost of imported goods.
Right.
It changes how much your vacation might cost if you're traveling abroad.
You get it.
Yeah, it affects everything.
Is it hard for businesses to plan?
Right.
Should they expand now or
Yeah.
wait and see what happens?
Exactly.
It's a tough call
Yeah.
to get a clearer picture of where things might be headed.
Okay.
We need to try to understand what's going on inside the Fed's decision-making room.
Right. Well, let's get inside their heads then.
Let's do it.
What are they saying, and how are the markets interpreting those signals? This is where it gets interesting.
It really does. The Fed, as we've been saying, is walking this tightrope.
Mm-hmm.
Their latest projections actually point to fewer interest rate cuts in 2025 than they had previously hinted at.
Oh, wow. So if they were already leaning hawkish, this seems like they're doubling down.
Yeah.
What's driving this bolder stance? Well, the Fed tends to err on the side of caution,
Right.
Think of it like this. They want to be absolutely sure they have inflation under control
Okay.
before they even consider easing up on those interest rates.
Gotcha.
Imagine, letting up too soon and then inflation makes a sudden comeback.
Right. It's like thinking you put out a fire and then as soon as you turn your back, it flares up again.
Exactly.
Yeah.
And, the Fed's main job is to keep prices stable.
Mm-hmm.
And while they also care about keeping unemployment low right now, tackling inflation is their #1 priority.
Right. But haven't we seen some signs that inflation might be cooling down already?
Yeah.
Doesn't that change things?
It certainly adds another layer of complexity.
Yeah.
The markets are basically playing a guessing game right now, trying to figure out if this recent PCE data will be enough to change the Fed's mind.
So everyone's kind of holding their breath, waiting to see if the Fed flinches.
Exactly.
What are some of the opinions that you're hearing out there? Well, you've got some analysts who are convinced that the Fed will stay the course, keep interest rates higher for longer.
Okay.
Their argument is that this recent dip in inflation is just a temporary blip,
Okay.
and that those underlying pressures are still very much there.
So they're saying the Fed shouldn't get distracted by one data point.
Exactly.
Interesting. What about the other side? What are they saying?
On the other side, you have those who believe that this softer PCE data,
Okay.
coupled with some of the other economic indicators,
Yeah.
gives the Fed a little bit of wiggle room.
Okay.
They argue that the Fed can afford to be a bit more patient,
Right.
watch how things unfold before making any drastic moves.
This is what makes following the economy so fascinating.
It is.
We're all on the edge of our seats just waiting to see which way the Fed is going to jump.
Right.
What are some of the potential outcomes we could see, depending on which path they choose?
Well, if the Fed continues with their hawkish stance,
Right.
it could put a damper on economic growth,
Yeah.
potentially even leading to a recession.
Oh, wow.
But on the flip side, it would likely keep the dollar relatively strong.
Okay, and what if they decide to ease up a bit? What could happen then?
Well, easing up could help stimulate economic growth,
Okay.
but it also carries the risk of weakening the dollar
Okay.
and potentially fanning the flames of inflation again.
It's a tough call. No wonder the markets react so strongly to every new piece of economic data that comes out.
It's true.
Speaking of market reactions, let's shift our focus to what's been happening with the US dollar index.
Okay.
The DXY, we touched on it earlier, how it dipped after the PCE data was released.
Right.
What's the latest on that?
Well, as we mentioned, the DXY slipped below that 108.00 mark.
Okay.
Right now, it's hovering around a 107.60.
So just a slight pullback. Is this a sign of things to come or just a temporary blip? How can we decipher what this all means?
Well, to get a better grasp on that, we need to look at some technical indicators.
Okay.
One key indicator to keep an eye on is the 20-day simple moving average.
For those of us who aren't expert chart readers,
Yeah.
could you break that down for us? What does that mean and why does it matter?
Absolutely. So in simple terms, the 20-day simple moving average is a line that shows the average closing price of the DXY over the past 20 days.
Okay.
It helps us smooth out those daily ups and downs and gives us a clearer sense of the overall trend.
So how does this 20-day average connect to what's happening with the DXY right now?
Well, if the DXY manages to stay above this key average, it could be a sign that the overall upward trend is still in play.
So potentially more gains for the dollar?
Precisely, however. If it drops further and dips below this average, it could signal a shift in the market's mood,
Okay.
potentially hinting at a weaker dollar on the horizon.
Once again, we're left with a little bit of a cliffhanger.
We are.
What other technical indicators do traders use to try to get a sense of where things might be headed?
It's a great question. Aside from the 20-day simple moving average,
Hmm.
traders also rely on other tools like the Relative Strength Index or RSI and the Moving Average Convergence Divergence or MACD.
Gotcha.
These indicators can help to paint a more detailed picture of market momentum and potential trend reversals.
So it's like having a whole toolkit to analyze the market.
Right.
Each tool providing a different piece of the puzzle.
Exactly. And remember, no single indicator tells the whole story.
Right.
It's about looking at the bigger picture
Yeah.
and considering all of these factors together.
It sounds like understanding the US dollar is a bit like solving a mystery,
It really is.
with clues hidden in all these different economic indicators and market signals.
You could say that.
And as with any good mystery, the stakes are high.
They are.
The performance of the US dollar has ripple effects throughout the entire global economy.
It really does.
It impacts everything from international trade to investment flows to the prices that we see every day for goods and services.
Exactly.
Yeah.
So while we can't predict the future with absolute certainty,
Right.
understanding these trends and these indicators can empower us to make more informed decisions, both personally and financially.
That's excellent advice. Now let's zoom out a bit and talk about what these trends mean for the overall U.S. economy. So we've got this kind of interesting contrast playing out in the U.S. economy right now.
Yeah, it's a real puzzle.
Yeah.
On the one hand, we're seeing strong Q3 GDP growth
Right.
and pretty robust consumer spending.
Yeah.
It seems like American consumers are still out there, shopping,
Yeah.
even with inflation and those rising interest rates we talked about.
You'd think that would put a dent in things.
You would think so.
But the U.S. economy seems to have some real resilience.
Exactly.
Yeah.
But then you look at the forecasts for Q4 growth,
Yeah.
and things get a little bit murky.
Okay.
The Atlanta Fed's GDP Now model is projecting a healthy 3.2% annualized growth rate.
Okay.
while the New York Fed's nowcast is significantly lower, coming in at 1.9%.
Wow, that's a pretty big difference.
It is.
What could explain such a gap between those two models? I mean, it seems like they're painting two very different pictures.
They use different methodologies,
Okay.
and they weigh various economic indicators differently.
Okay.
The Atlanta Fed's model, for example,
Mm-hmm.
is known to be much more sensitive to real-time data releases.
Okay.
Kind of like a quick pulse check on the economy.
Gotcha.
The New York Fed's model, on the other hand, takes a much broader approach, incorporating a wider range of factors to get a more comprehensive view.
So it's not just about the numbers themselves, but how you interpret them and kind of the lens through which you're viewing this data?
Exactly. And this uncertainty, this is another layer of complexity for investors that are trying to navigate these pretty choppy economic waters.
Yeah, I bet.
If the economy is indeed headed for a slowdown, some sectors might be more vulnerable than others.
So diversification is key.
Absolutely.
Don't put all your eggs in one basket.
That's a fundamental principle,
Yeah.
especially in times of economic uncertainty.
Right.
Staying informed about these economic indicators,
Yeah.
understanding the different forces at play,
Yeah.
that's going to help you make more informed decisions.
This has been a really insightful deep dive.
It has.
As we wrap things up, what would you say is like the key takeaway for our listeners who are trying to make sense of the US dollar and inflation and just the overall economic outlook?
I think the main takeaway is that the U.S. economy is sending very mixed signals right now.
Yeah.
We are seeing signs of strength,
Uh-huh.
but there are some underlying vulnerabilities.
Yeah.
The Fed's reaction to this latest PCE data will be crucial.
Okay.
And, their next move will likely have ripple effects on both the economy and the U.S. dollar.
It's a real cliffhanger.
It is.
Well, I'll be watching closely to see how this economic drama unfolds.
Absolutely.
To our listeners, we'll leave you with a thought-provoking question to consider.
Okay.
If you were advising the Fed, what would you recommend they do next and why?
That is a complex question.
Yeah.
With no easy answers.
It really is.
But it's a question worth pondering
It is.
as we all try to navigate this uncertain economic landscape.
Absolutely. Well, thanks for joining us on this deep dive.
Thanks for having me.